Did you know that you can buy property using a life insurance policy? I've been helping real estate developers and investors do this for more than 10 years. And in this video, I'll show you exactly how you can do this, and I'll go over the real numbers everyone should be looking at. The first thing I'd do is understand exactly why you would use life insurance to buy property and how the cash value gives you access to capital without having to use cash, liquidate other assets, or wait on a bank. Now, most people think that life insurance just pays out when you die, but people who understand how the cash value works are using it to fund deals right now. So what happens if you see a property that you want to buy, but you don't have the cash? So let's pretend that this is you. You see a property over here, but you don't have enough cash in the bank to buy it outright. So you go to a bank and you get a loan. So now you can get that property, but first you've got to go through the bank's process. Does that feel good? No. For most, it's very, very painful. Usually the process is very slow. They pull my credit. There's a lot of paperwork, and they review my financials constantly. Sometimes I even have to keep a certain amount of cash in the bank. This way I can be approved for a loan. So it's very painful, and a lot of people don't like it. Now, on the flip side, let's assume you're someone who has accumulated a lot of money and you've got cash sitting in the bank for the specific reason to buy more property when the opportunity presents itself. The hard part about this for a lot of people is, one, having a lot of cash in the bank is usually a big lost opportunity cost because banks don't pay that much interest. But two, do I trust the bank? Meaning, do I feel comfortable having millions or tens of millions of dollars sitting in checkings, savings, and money market accounts? A lot of people don't. So this is where a whole life insurance policy comes into play and is attractive to so many people. So with the whole life insurance policy, first, the growth rate usually falls somewhere between 4 and 5%. Also, when you take that 4 to 5% return, provided we follow IRS rules, that can also be tax-free. Which means if I'm in a high tax bracket, 5% might feel more like 8%, which makes it very, very attractive. And then lastly, I've got a unique loan feature that allows me to function as my own bank. Once a dollar passes through the cash value of a life insurance policy, that dollar is compounding for me indefinitely, meaning even when I borrow against the policy, I constantly receive that ongoing compounding. Here's a quick example of how it works and how I can use it to buy real estate. So let's assume that I have a whole life insurance policy in place and I've built my cash value up to $1 million and it's compounding at a rate of 5% per year. Now, I see a piece of real estate that I need $500,000 to purchase outright. I have enough in cash value. So to get that money, I take a loan against my policy for $500,000. There is a cost to borrow or loan interest, and that might be 5%. So I do pay interest on policy loans to the insurance company. Now, when I borrow that $500,000, I see my available cash value to borrow drops from $1 million to $500,000, just like a line of credit would. My death benefit also drops by $500,000. The life insurance company is holding the death benefit as collateral whenever I take a loan. I took that $500,000 to do what? To buy this property. So I acquired the property, and let's assume that I wanted it because it provides a very consistent cash flow of 8%. So 8% of $500,000 is $40,000 per year. So what we'll see one do is take that $40,000, whatever the returns are, and use that to repay their policy loan. Maybe it's not all of the cash flow, it could just be some of it. You can pay policy loans back however you'd like. But as you're repaying that loan, you see your cash value being restored. But here's the thing. The whole time you're doing this, you're still receiving compound interest on the full $1 million. So before you took any loan, we talked about the $1 million compounding at a rate of 5%. That's happening when you take that $500K loan out. So you receive the constant compounding year over year. So let's assume years later, you pay this loan off in full. What was the cost? The amount you paid in loan interest, specifically on that $500K loan. But what did I gain? Well, I gained a lot. One, my cash value continued to compound. If I'm looking 20 years plus down the road, that may have compounded to $3 million. and I own the real estate. The real estate has likely appreciated, and I've continued to receive the cash flow. See why we call it becoming your own bank, where you're no longer working with a bank, but your cash value becomes your source of financing? Now you've taken control of this aspect and you've acquired the real estate. This is why so many people use cash value life insurance to buy real estate. But the big thing that I hear from most people is that they enjoy the convenience of it more than anything else. Where else am I going to be able to get a loan in 2 to 3 days without any paperwork or just 1 or 2 signatures, no underwriting, no impact on my credit score, and I can pay the loan back however and whenever I want? Hard to find that. That's what life insurance gives you. The way that a policy loan is structured gives you a cost of borrowing that a traditional bank cannot match. Banks will typically front load the interest that I'm going to pay. Imagine if you can be the bank and cut that piece out. Now all of a sudden, it gets that much better. So this is exactly what we'll see real estate investors do. I'll give you an example of how I like to look at this. Here we've got a policy set up for a real estate investor. Now he's planning to fund a total of $1 million over 10 years. He's not obligated, but this is his plan. So in the first year, if you put $100,000 into a policy and you have $92,000, you didn't earn anything. You lost about 8%. That's why we see a negative return here. The worst part about a whole life insurance policy is the first year. The best part is every year after the first year, as it gets better and better. Let's take a look at a loan in action. So here, we're going to take a policy loan when he is 50 years old at year 11. Now you can borrow anytime you want. It can be 10 business days after starting a policy. I did it in year 11 because that's after the funding. So it just makes it easier to follow the illustration. So when he pulls that $500,000, the question that I would advise him to ask is, how does that impact my policy? My cash value is now $785. Before I borrowed, what was it worth in policy year 11? $1.3 million in change. The cash value dropped by the amount that he borrowed, $500K, plus the loan interest that is being accounted for the following year. How about the death benefit? That's worth just about $1.8 million. If I look at the example where I never touched it, it was worth just about $2.3 million. So my death benefit was reduced dollar for dollar by the amount that I borrowed against the life insurance policy. Now in this example, he's paying the loan back somewhat aggressively at $100K per year. When that loan is repaid, what do you notice about the cash value and death benefit? We can just look at the bottom of the chart. His cash value is about 2.2 and his life insurance is more than 3.2. Look at the example where he never touched it. His cash value, 2.2. His life insurance benefit, 3.2. The money kept on compounding. The first step in using life insurance to buy real estate is setting the policy up the right way before we ever need it. Because the worst moment is to figure out that there's a deal waiting there and you don't have enough money in cash value, or the product just doesn't work because it was set up incorrectly. Structuring your life insurance policy the right way is the key to making sure you have enough cash value for that next deal. Almost every real estate investor I work with typically wants to have the option to put a lot of money into a life insurance policy, but they don't want to be obligated to have to pay a big premium every year. They want it flexible. So here's how you can make a policy very flexible. So let's pretend that this is you, Mr. or Mrs. Real Estate Investor. You want to put up to $100,000 per year into a life insurance policy, but you don't want to get a bill for $100K because that's going to stress you out. So we design a policy to be very, very flexible. So what we can do, if your target is $100K per year, is we can set your minimum premium at about 10% of that. That's typically the lowest I can drive it. So if your target funding amount is $100K, I know that I can set the minimum as low as $10,000. So this means you would get a bill for $10,000 per year. That could even be paid monthly if you wanted to make it more flexible. And then you could add the additional $90,000, 100% at your discretion. That's added through your paid up additions rider. And with some companies, this rider is extremely flexible to the point where you can just log on to an online account and throw money into this rider, and you immediately see that show up in cash value. So here's an example of that real estate investor. The first year cash value stinks because we're only paying the minimum. I've got a high death benefit. That's really to make sure the policy can handle up to $100K per year without becoming a modified endowment contract, which would be a taxable event. But We're setting it up where they're only billed for the minimum. Their plan is to do this: fund $100K per year. So in addition to the $10,000 that they're billed for, they want to add another $90K per year toward their PUA rider, which accelerates the cash value growth of the policy. And then also, after 5 years, they want to stop altogether. This way, they can allow the cash value to continue to ride over time and then borrow and repay and use it like a high-yield savings asset that functions like their own bank or line of credit that they can tap into without the obligation to make future premium payments. The next step is actually using the policy to fund your next property purchase. Now, the process is way easier than working with a bank. If I'm working with a bank, I might have to wait up to 90 days before I actually get that loan from them. But with a life insurance policy, when I request a loan, I get it in 2 to 3 days. That's it. So here's a quick example of someone who is using a policy very aggressively, specifically for their business. But this exact strategy applies to real estate as well. So we have a doctor, and his exact plan was to put $5 million into a whole life insurance policy over a 5-year period. Now, during that 5-year period, he wanted to aggressively borrow against the cash value for his business. But then after the 5th year, he wanted to stop paying premium and then just focus on paying back the loan. The reason why is because he knows the cash value will continue to compound. So in 20 years, that $5 million he's paid in should be worth well more than $10 million, and it's also tax-free. So here's a policy showing exactly that. We've got $1 million per year going in. It's very cash-rich upfront, or we're at 92% of what he deposited. The break-even point is very close to year 3, meaning his cash value is greater than his total payment at this point in time. After the 5th year, he pays nothing, and that cash value compounds over time. By the 20th year, the cash value, $12.2 million, and the life insurance benefit is almost $17 million. It's a big policy. So his plan is to borrow $800,000 or 80% of what he's depositing for the first 5 years. So you've got 5 loans of $800K. He's not paying any loan interest during this time period. Then after he's funded the policy for 5 years and after he's taken those loans, he then begins to focus on paying that loan back. So he's still going to be borrowing and repaying, but the net payment that will actually go toward the loan in this example is $500,000. And we can see how much is going toward the interest and how much is going toward the principal. You can pay it back as quickly or take as long as you'd like. In this example though, he's repaid it, and let's look at the 20th year. Cash value, about $12.2 million. Death benefit, just about $17 million. The policy value is fully restored to exactly what it would have been as if he never touched it in the first place. So the money kept on compounding over the years. So in a case like this, because these are some big dollar amounts, what I like to look at is what is the total interest I paid to the insurance company over time compared to the total amount of interest I received from the insurance company over time. Let's take a look. If we look at the bottom, by year 20, the total amount of interest you've paid is about $1.9 million. But how much did your cash value grow by? About $7.2 million. Where that number comes from is in year 20, you want to take your total cash value of 12.2 and subtract the amount of money you've paid in, $5 million. The difference is the gain. So in this case, $7.2 million. So if I want the net result, I would take my gain and I would subtract the interest from that, and that gives me a net of about $5.3 million. And remember, this is a life insurance policy, and we've followed IRS rules, which means we can access that money completely tax-free. And he's been accessing it tax-free the whole time as well. These plans can be absolutely beautiful, but they can also blow up. We definitely want to avoid a situation where the policy implodes or lapses, because that can cause all sorts of problems like a taxable event and such down the road. We don't want that to happen. So the next step is to track your numbers every year so you know exactly whether or not using your policy to buy real estate is truly working in your favor. If the policy is growing more than what the loan is costing you, you're going to be moving faster than 99% of people. Let's take a look at the cumulative numbers. Let's assume you've had a policy for a long time and you've paid a total of $100,000 into it. Now, over the past 30 or 40 years, pretend that you're older now and that cash value has really compounded. and it's worth $500,000. What's your gain? $400,000. Now, over the past 30 years, you've borrowed and repaid, and when we tally up the total amount of interest you've paid, it's $200,000, which means what? Well, your net spread is $300,000. The thing is, I can easily calculate what I am receiving from the insurance company versus what I am paying them. It's just really a case of seeing that up front and then knowing how I can calculate that, or having your agent do it for you, which is pretty simple to do. So if you want to understand your numbers, I would look at these two things. First, the annual results. What did the insurance company pay me in total dividend and interest, and what did I pay them in loan interest? Compare the two side by side. And then second, I would look at the total returns. What is the total amount of dividend and interest the insurance company has paid me over time? And what is the total amount in loan interest I paid to the insurance company? You know, what's interesting is when I talk to people who use cash to buy real estate or purchase investments, a lot of times they feel stuck in the same spot because money goes in and out of the account, and money in the account doesn't earn that much, just when you look at interest rates that banks are paying. But two, as soon as you pull the money out, you're no longer earning interest. Whereas when they see a life insurance policy and see the fact that when they borrow against it, their money keeps on compounding, and they see that the dividends and interest often equal and sometimes exceed what they're paying in loan interest over time, that's when they say, okay, I get it, and I love the fact that my money's compounding indefinitely because now I don't feel stuck. I'm getting the benefits of my real estate over here while the money that I've used to acquire the real estate keeps on compounding. That's a win-win. And that's where we see a lot of people end up taking out large policies. So the final step is structuring the loan so the interest potentially becomes tax deductible on everything else. So with a life insurance policy, you can always access that cash value tax-free provided we follow IRS rules. Very simple to do. But the interest that we pay on the loan, there's a way you can actually write that off too. So first, if I borrow against my life insurance policy, the loan interest is typically not tax deductible. You'll see IRS language that says exactly that. Some CPAs will argue that you can still deduct the loan interest if you're using it for business purposes. Others say, nope, I'm not comfortable with that. However, where I've seen every CPA comfortable with deducting loan interest that's generated from a loan against a life insurance policy is with what's called a cash value collateral loan, or a cash value line of credit. So I've actually done this in the past, and I'll show you exactly what I've done. So several years ago during COVID, when interest rates were very low, I could borrow directly against my policy at a rate of about 6%, or I could get a loan from a bank at 3%. That was a lot more attractive, obviously. So what I did is I had a personal policy in my name, and I took my cash value and assigned it as collateral to a bank. The bank gave me a line of credit up to 95% of my cash value, which is about the exact same maximum amount that I could borrow directly against my policy from the insurance company. So there's no difference there. So I get a line of credit, but here's the thing. I applied for that loan in my company's name because my intention was to only use this loan for business purposes. What does that mean? Well, it means that the interest can be tax deductible. So the cash value continues to compound. I'm following IRS rules, so I've got the tax-free benefit, and I'm able to capture a tax deduction here. I felt like that was powerful. The big important piece about this is always make sure that you're speaking with your accountant or CPA, because looking at the IRS language, specifically around deducting interest on life insurance loans, I've read mixed opinions. With these loans with a bank, they're much more straightforward. But still, I would speak with your CPA. This way, you're safe. So I hope you enjoyed this video. This is actually one of my favorite things to talk about. We work with a lot of real estate investors in setting up new policies and helping them use their existing policies. But if you'd like to see more, I included a really cool case study that goes over how a real estate investor bought a lot of property and exactly how he leveraged the policy as a tool to do so. You can see that video here.